Welcome back to the deep dive. We're looking today at early October 2025, and things are getting really complex out there in the global markets.
Absolutely. It feels like we're watching this great divergence play out in real time.
Right, and that's our goal today, isn't it? To understand how these three major economies, the US, the Eurozone, China, are running at totally different speeds.
Exactly. And how that's forcing central banks apart and creating, well, some pretty weird trading conditions. It's like a three-speed world right now.
That's a good way to put it. Those crosscurrents seem to explain a lot about where capital is flowing.
It's really the only lens that makes sense if you want to grasp why assets are behaving the way they are.
Okay, so let's start with the US. It feels like it's walking this financial nice edge.
It really is. You've got conflicting signals everywhere.
Like the backward-looking stuff looked great, right?
Yeah.
Q2 GDP finalized, what was it, plus 3.8% annualized? Pretty strong.
Yeah, seemed robust. But then you look at the more current, forward-looking indicators.
And the labor market is flashing red. That 3-month average for new jobs, down to just 29,000.
Tiny. And unemployment ticked up again, 4.3%. That's a clear cooling trend.
What's wild is how the market reacts now. This is the paradox, right?
Totally. A year ago, those job numbers, market panic. Now, bad news is good news.
Explain that a bit more. How does weak labor data suddenly become positive?
Well, it's all about the Fed. Investors aren't really trading the economy's health anymore. They're trading the Federal Reserve's likely reaction.
Ah, so weak labor data just means.
It means the odds of Fed rate cuts go up. Maybe bigger cuts, maybe sooner. And that's what's propping up stocks, bonds, you name it. It's all about future easing.
Which leads us straight into this massive split between central banks.
The great decoupling.
The Fed clearly pivoted in September, cut rates, cited those downside risks to employment, basically promised more cuts soon, maybe 50 basis points by year-end.
Yep, they're easing pretty aggressively, trying to get ahead of any potential recession.
But then you look across the Atlantic. The European Central Bank. Totally different story.
Completely different. They're holding rates steady. They think inflation's basically beaten back near 2%. They're saying policy is, quote, in a good place.
So Fed cutting, ECB holding. You said this creates a headwind for the US dollar. What does that practically mean for someone listening?
Well, it's pretty straightforward. When one major central bank cuts rates while another holds steady, capital tends to flow away from the currency with the falling rates.
So money moves out of the dollar.
Basically, yeah. It creates this structural downward pressure on the US dollar, bullish for the euro against the dollar, obviously.
And that impacts commodities too.
Right, especially things priced in dollars, like gold. A weaker dollar makes gold cheaper for buyers using other currencies, so it boosts demand.
Okay, but let's connect this to the third player, China. How does China fit into this Fed easing story? They're the ones sending cheap goods everywhere.
China's still the big source of global deflationary pressure. Their manufacturing PMI dipped below 50 again, 49.8.
That's the 6th month of contraction, isn't it?
6th month. It's all tied to that ongoing property crisis. Domestic demand is just weak.
So they export that weakness.
In a way, yes. They export deflation through cheaper goods because they can't sell enough at home. That actually helps keep inflation down in places like the US and Europe, but it also kills demand for industrial commodities.
You can really see that split in the commodity prices themselves. It's dramatic.
It is. Look at gold, surging past $3,900 an ounce. That's up, what, nearly 48% this year.
Wow. Driven by those Fed easing bets and maybe some safe haven buying.
Exactly. It's a bet on the Fed stepping in. But then you look at oil, WTI crude.
Collapsed. Down around $61 a barrel.
Total opposite story. That's fears of a supply glut, maybe OPEC plus increasing production, hitting weak Chinese demand head on. Gold loves the Fed easing. Oil hates the China slowdown.
Okay, wait a second. If we've got a shaky U.S. labor market, China struggling, and a U.S. government shutdown that started October 1st,
Yeah.
how is the VIX, the fear index, so low? It's sitting around 16.7. That feels complacent.
It is complacent, and that's the final paradox here. It's kind of counterintuitive, but the shutdown itself is almost helping keep volatility low.
Wow.
Think about it. The government isn't releasing key economic data, labor reports, inflation numbers because agencies are shut.
Right, the data vacuum.
That vacuum actually reinforces the Fed's dovish stance. They don't have fresh, strong data that could argue against cutting rates. So an October cut looks like almost a sure thing now.
So the market's just banking on the Fed having its back no matter what, overriding all these other visible risks.
That seems to be the narrative priced in, yes. Massive faith in the Fed put.
But that sounds incredibly risky. It sets up this asymmetric profile, doesn't it?
Hugely asymmetric. The market is priced for a soft landing managed by the Fed. But here's the final thought for you to really chew on. What if these headwinds, like a really long shutdown or China's problems getting much worse, what if they prove too bad, even for the Fed?
What if monetary policy isn't enough this time?
Exactly. If the market suddenly doubts the Fed's power, given how low the VIX is, well, the repricing of risk could be incredibly fast and violent. That's the hidden danger in this divergence.